You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. Sometimes the best trade is no trade at all. How can we make sense of August the 5th, which was Monday of this week, of course, and we had a 1,000-point drop in the Dow Jones and quite a bit of volatility. There was some panic selling. We saw a lot of concerns and a lot of talk from economists that we're headed towards recession. How do we make sense of all this? And as I say, sometimes the best trade is no trade at all. So we're going to talk about that. We're also going to talk today about Donald Trump's proposed Social Security tax cuts, which would actually make the trust fund run out a little sooner than it already is slated to run out. What does that mean for you and me and what we can plan on with Social Security, and how can we be effective? And we're going to talk about other challenges to being able to retire at age 65 in terms of income stability. But let's make sense of August 5th. Now, while I'd love to cut right to the chase, I do want to mention that I think many of this week's problems can be solved by proper asset allocation. And having an income plan that does not put dependence on short-term cash needs on volatile market investments. And that's really the underlying theme here, is if you've got the right asset allocation plan and you've got an income plan in place that you don't depend on short-term market performance, then you can be patient rather than clever, because sometimes I think it does pay more to be patient than clever with things like this, because we know market timing doesn't work. We know markets are volatile inherently, and they're completely unpredictable. Now, it is weird to state it, but it feels like investors have wanted to see market fireworks and maybe a pullback for quite some time. I mean, over the past month, not only have we witnessed a dramatic rotation from U.S. large cap stocks to U.S. small cap stocks, we've also had a lot more political fireworks as well. So what is going on? Is the market heading into a recession off of slower growth and a mistake in federal policy? Because, in terms of the Federal Reserve not lowering rates quickly, that is what is dominating the news this week, with what happened Monday and Friday to a degree too, because the market was down pretty sharply last Friday, meaning a little over a week ago. I don't think that this is necessarily the case. I think that it's a little bit overblown. The market or the economy is showing signs of slowing down, so we'll talk about the impact of all that. But are we definitely heading into a recession with slower growth, and has the Fed completely made a mistake by not cutting rates so far? I don't think that's where we are. Now, if we look at everything that's going on, corporate earnings have been very mixed. They've not been universally bad, but there have been more signs of weakness with corporate earnings than in any other quarter since we saw COVID-19 in 2020. We also have the Magnificent Seven, the big tech mega caps, NVIDIA, Apple, Microsoft, Meta, the big technology firms. They started to see they're in a correction. The thing is, What does that really mean for AI in the future? We're not sure. There still could be big payoffs in AI, and then I think those companies, those Magnificent Seven companies, they're more motivated to provide infrastructure to grow aggressively than to be caught holding the bag and not expanding. And then the Fed, the market is starting to take more seriously that the Fed, has not cut increases or cut interest rates, and have they overstayed their welcome and waited too long? We really haven't heard the recession narrative since early this year, but it is creeping back into the market. And then finally, there's, seasonality in the market. We're entering a tough seasonal period for equities. August usually pretty flat. September and early October tend to be the weakest period of the year. Now that doesn't mean that's what's going to happen, but we do have some headwinds here. But the thing that happened this past week, I think, was somewhat overplayed. And I think politics has had a big piece to do with that. A lot of what was driven last week came from forces outside of the U.S. and from traders. And I talked a little bit about this this week on the radio. I was on with Bob Yarbrough, and it's really not being talked about at all. And I don't want to get too complicated because it is kind of complicated, but traders were taking advantage of the fact that the Bank of Japan has been very reliable in keeping interest rates near zero in Japan. And so traders would borrow money in Japan, they would convert it to dollars, and they would invest it here. Now, sometimes they'd invest it in treasuries, and then sometimes they would actually invest it in things like the Magnificent Seven. But then a couple of things have happened. Interest rates on the 10-year treasury have fallen pretty precipitously in the past few weeks. And then the Bank of Japan at the end of July made an announcement of a rate hike. And it kind of caught these traders, they weren't ready for that, and they kind of had to unwind what they did. And it basically, in a long story short, it made for panic selling. And when we see panic selling, volatility leads to more volatility. Selling leads to more selling. And so we kind of got in this snowball. And that really was the number one thing that drove what happened on Monday. Now then, we do have these other headwinds, though, that I just kind of went through with more mixed corporate earnings, concerns with the mega cap Magnificent Seven, and all these other things that I'm talking about. So we do have some things going on, and we could end up in a recession. We absolutely could. But I think the narrative this week about recession and about the Fed needing to, in an emergency, step up and cut rates, I think that's fully overblown, and I think a lot of it is politically motivated. Because both parties, as we approach the election, both parties want to blame the other side for economic turmoil, for stock market decline. And the incumbents, the Democrats, they know that it's hard to re-win election when the economy is viewed to be poor or the stock market is bad. So the reality is there's been a ton of volatility. The uptick in volatility in the markets, and then the subsequent downtick after Monday is somewhat unprecedented. I mean, we have this from time to time, but it has been remarkably high, the changes in market volatility. And that market volatility usually leads to more market volatility in the short term. And that means we're likely to see more volatility and unpredictability in the markets. And typically that can mean swings down and swings back up. And that's the problem with trying to time things like this. When do you get out? When do you get back in? And in the end, how much of this volatility is real? So usually after periods of higher volatility, we usually see good market conditions in the subsequent 6, 12, and 24-month periods. So kind of back to my original point that asset allocation is what is most important. We know markets are completely unpredictable in the short term. We can always be subject to increased volatility, and usually it leads to more volatility before things eventually settle down. We've got an election coming up in November. There's tremendous uncertainty geopolitically around the world. We know markets are inherently can be volatile, and so we shouldn't be trying to time these things. We need an asset allocation plan in advance that can protect us from the big losses, but still be able to take advantage of the booms when they happen. And these periods coming up, yes, we probably are going to see more big downturns on certain days, but we're also probably going to see some nice rallies on other days. And I think time in the market becomes more critically important than your timing of the market. So back to my original comment leading off the show, sometimes the best trade is to make no trade at all. Now, when we come back, I do want to talk about the Federal Reserve and are we headed to recession? What are my thoughts and what should you be doing about that? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living here on News Talk 98.7 WOKI. I'm your host, Jim Brogan. And with the economic turmoil or the stock market volatility we saw this week, there's more and more discussion of the Federal Reserve cutting interest rates to stave off a potential recession. I continue to believe that I do believe the first Fed rate cut will be in September, and it will likely be the start of a sequence of cuts. Now, with that being said, I personally don't see the case for a jumbo cut, meaning 0.5% or 0.75%. Now, they may do 0.5%. Don't get me wrong, but as of right now, I don't see the case for that. Now, the trend line for unemployment is up, and it's up to a level where there are fears of recession. But, the Federal Reserve is having a meeting later this month at Jackson Hole, and I think it needs special attention because we'll get additional clues on how the Federal Reserve is feeling. But, at his press conference recently, the Fed Chairman Powell did say, and I quote, "Economic outlook is uncertain and the committee is attentive to the risks to both sides of its dual mandate." Well, what its dual mandate is to keep full employment and to manage prices, keep inflation down. So I think what Jerome Powell was saying recently is they're more and more in tune to the fact that unemployment is increasing, and they may need to cut rates. Now, the recent sharp decline in equity prices has led to a talk of an emergency move by the Fed ahead of its planned mid-September vote. And to me, barring a big financial disaster, I don't think it's going to happen. U.S. central bankers are nowhere near as bearish or as knee-jerk as investors seem to be right now on America's economic prospects. And I think one of the worst things the Fed could do here is overreact with an emergency cut based on a few choppy market days, again, mostly due to ex-U.S. forces. Now, there has been some normalizing economic data. In other words, some of the economic data is starting to come down. And so that is absolutely something to keep an eye on, but the data is not terrible. So as of right now, the market seems to be pricing in a cut for September and maybe as many as 4 cuts the rest of the year. Personally, I don't think we'll get 4 cuts the rest of the year. Now, we might. I think 2 to 3 is likely to happen. Now, what does this mean for you and me? Number one, if we get less than 4 hikes, the market is going to interpret what the Fed does and it could overreact in a positive or a negative way, which again creates more volatility in the market potentially. So we just have more uncertainty. I do think we're looking at, rate cuts. I know following periods of extreme volatility, and then when that volatility drops, we tend to have pretty good markets. But the bottom line is, as I said in the first segment, we don't know in the short term. So the real key here is twofold primarily. One, have an asset allocation plan that measures and calculates risk. You know, the amount of risk you take, whether you're young or older, should be calculated. And it becomes even more important when you're getting ready to retire when you're retired, because that big economic downturns can be more devastating when you're needing to draw income from your life savings. So the first step is to not have too much volatility in your portfolio. And the great thing is that can be measured. We can measure that. There are great tools available to us that we use at Brogan Financial that allow us to measure risk and give us a pretty decent expectation moving forward of risk and reward. Now, please don't misinterpret me. I'm not saying, we know what markets are going to do or how much a portfolio could lose or how much it could gain, because as we know, markets are unpredictable. But in terms of, hey, if we have a bear market, what can I expect out of my portfolio? And if we see a booming market, what can we expect out of our portfolio? We can, if you will, stress test those kinds of things. And yeah, we could always get results different than what we expect, but measuring past risk historically has been a pretty good predictor of future risk. So having an asset allocation plan and measuring that risk, that's one of the first big steps. The other big step is to not depend on market investments in the short term. What you don't want to do is have to be selling off market investments when they're sharply down and spending that money for income, because then you'll compound your loss. That money will never ever come back because it's been spent. See, it's okay to sell something when it's down and reinvest it, but you never want to sell it when it's down and then have to spend it. Now, that leads me to my next topic, which is that more and more Americans are concerned that they won't be able to retire at 65. And I think all this kind of works together. There's a new survey by Equitable, and it reveals that a large share of Americans have lost hope on reaching a long enshrined milestone. Nearly half of American consumers believe retiring at the age of 65 is realistic, but rather than 65, a full 47% of respondents expect they'll need to work into their 70s, maybe as much as 74 years old on average, almost half. And the study respondents, they interviewed over 1,000 participants. The study respondents pointed to several challenges in achieving retirement security, including rising living expenses, inflation, insufficient savings, and a lack of guaranteed income. So let's just talk about those three things. Inflation. Everybody I meet with in my office and I talk to in the community and when I teach classes, everybody's worried about inflation, and it's taking a big chunk out of their income. And it's making people feel less confident in their ability to retire securely. Now then, insufficient savings. That goes to having a plan in place and making sure you're spending less money than you make and you're accumulating and saving money and you are making wise investment choices. And then finally, a lack of guaranteed retirement income. This is becoming more and more of an issue in the minds of people that are younger. Baby boomers typically are not as concerned about having guaranteed income in retirement because they've got Social Security. In some cases, they may have a pension. As we get younger into Gen X, I'm a Gen Xer, and then you get into millennials, post-millennials, There's more concern about the future of Social Security, and more as you trend younger in these surveys, more and more people they want the thought of guaranteed income in retirement. And guaranteed income is an important factor in retirement planning. How do you add guaranteed income to your plan? And typically you would do that through the use of income producing annuities. Now, annuities are somewhat controversial. They have their good, they have their bad. We've done whole shows on the good and bad and ugly of annuities and how they can be used effectively, how not to use them. I'm going to try to keep it kind of general today in this segment and say guaranteed income from annuities that can provide you with income that you can never outlive is an extremely valuable retirement benefit. However, there is a cost for those guarantees. It makes sense, right? If you're going to have a guarantee that you could never run out of income, then there's going to be a cost for that. Now, the proliferation of guaranteed income annuities have become so commonplace that what's happened is, a lot of times people hear the word income annuity and they think of a pension annuity, where you get a guaranteed income for life, but then you die, there's nothing left. But the commercial markets have come out with more and more income annuities where you maintain access and control to the principal, but you still have guaranteed income you cannot outlive. Whatever you do have left would still go to your heirs, your beneficiaries at death. So there are more and more of those things available, and some of them are attractive, but as I said, there is a cost for that. Now, what is that cost and who's going to bear the cost? Typically, you're going to have a smaller estate when you pass away, because that cost in an effective plan is going to be borne in the end is going to be borne primarily by the heirs and the value of the estate. There's going to be less left over probably for the heirs. Some of you may be listening to this and thinking, well, Jim, that doesn't bother me. So guaranteed income could be attractive to you. But there is a cost. And I think some of that, too, comes down to how much income do you need? If you have $1 million and you need to draw $20,000 a year for retirement income, that's a 2% withdrawal rate. Now, you'll need that to increase over time for inflation, and there certainly are other risks. But a 2% withdrawal rate increasing over time is a very, very achievable goal, in my view, with a good asset allocation plan and a good income plan. Does somebody that only needs 1.5% or 2% withdrawal from savings, do you need to be paying for a income guarantee? Yeah, you'll have guaranteed income from life, but do you really need that guarantee? Now, if you're taking out 3.5% or 4% or 4.5%, you have $1 million, you need to take out $35,000 or $40,000 a year to supplement income, you might want to consider guaranteed income. Because what guaranteed income does is it allows you to take typically, you can securely take a larger income in retirement because of the income guarantees. But then you're going to pass away with less money. So what is the cost? Who's going to bear the cost? And is that okay? And do you really need to pay that cost? I do have people come into my office that have programs in place that provide guaranteed income for life. But sometimes I see, that what they've done, they didn't really need that guarantee, and there's a huge cost. So it has to be carefully considered, and I think part of that is working with a fiduciary that is required by law to protect your interest alone, and that they disclose all conflicts of interest. Because, you don't want somebody selling you products when you're trying to decide, should you be using mutual funds or ETFs or stocks or bonds, or should you be using an income annuity? You want somebody that's going to give you advice to help you meet your goals and look at, hey, do I really need this? Maybe you do need it, but maybe it's a cost that is not necessary. So it has to be balanced with independent, objective fiduciary advice. Now, then the second part, too, is that I'll say you need a good income plan. If you don't have guaranteed income or don't have much guaranteed income beyond Social Security, then you do have to be looking at not depending on stock market investments in the short term to generate income. Now, it is, to be clear, it is okay to use dividend yield for income. You know, if stocks are paying a dividend yield, then you're getting those dividends. You can live on that. You can include that as part of your income plan. What you don't want to be is selling shares of stock or mutual funds or ETFs, selling shares of a security to generate income when the market is sharply down. And we know the market will be sharply down at times. And you need time on your side to ride through those ups and downs. In that first segment, I was talking about the choppiness and that we're likely to see more volatility because volatility begets volatility. It's just the nature of markets. When you're investing and taking risk, you should be investing for a period of at least several years where you don't need to depend on that money to to sell off and generate income. So having a good income plan is one key, and then considering guaranteed income can be a very, very good thing. Just realize that there is a cost for guaranteed income for life. Now we're going to get to our bottom of the hour break, and when we come back, I want to talk about Social Security. President Trump this week proposed Social Security tax cuts that would end up enriching Social Security benefits somewhat over time. How reasonable is that? And what are my thoughts on the future of Social Security and on your Social Security election? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in to More Living with Jim Brogan, where it's all about living the best years of your life your way as you listen to News Talk 98.7 WOKI. Donald Trump this week proposed Social Security tax cuts that would increase the net benefit to retirees. Is that a good idea? What do we think about the future of Social Security? How could this all be impacted? We have Tom, who has called in with a question specifically about Social Security. Good morning, Tom. Welcome to More Living. You're on the air.
How are you?
I'm doing great. Thank you.
My question, it's really regarding all U.S. dollars. What is your opinion on what is going to happen once the BRICS institute their dollar or their currency? What is going to happen to the U.S. dollar and their buying power? Because what I had heard is that it was going to the BRICS currency was going to equal 50 U.S. dollars. One BRICS dollar was going to equal 50 U.S. dollars. And is that going to cut the dollar's buying power by that amount or close to it? I'm trying to understand the impact. And I have really not heard anybody talk about it. It's like nobody wants to talk about the elephant in the room. And it just seems like no one's giving any advice on what to do in case this happens or when it happens. Because it really sounds like it's an inevitability at this point.
Well, there is a lot of uncertainty. So thank you, Tom, for your call, and I'll just kind of give some commentary on that. He's talking about the BRICS currency. That's Brazil, Russia, India, and China have an alternative currency. It is definitely something to watch. I don't think it's a certainty that that's going to come to a whole lot, but it is definitely something to watch. One thing I've talked about with the value of the dollar for years is that when we see the major oil when we see the major oil countries, not Iran, not Venezuela, but Saudi Arabia particularly, trading oil in something other than dollars, it's definitely something to watch. Could that lead to a decline in the dollar? I think the biggest thing, Tom, is we're really kind of uncertain as to how that's going to evolve. We don't know yet. So it is absolutely something to watch. However, I continue to believe in the resilience of U.S. markets, and I think it would be unwise to try to time a significant decline in the dollar. Now, one thing I will add there is I think regardless of who wins the election in 2 months, I think we're going to see in the next 4 years, we're going to see a decline in the dollar. And I think if Trump is elected, it'll be a bigger decline than if Biden is elected. And the reason for that is it helps trade. So it helps U.S. manufacturing. So I think that is, a decline in the dollar is somewhat likely to happen over the next 4 years, but I wouldn't tie it directly to this alternative BRICS currency, but it is something we need to watch. Now, Social Security, which kind of ties into all this because it's what is the solvency and security of our U.S. system and Social Security. So Donald Trump this week did promise retirees that he would end the tax on Social Security benefits if elected. See, your Social Security income can be subject to taxation. Now, many Social Security recipients don't pay income tax on their Social Security, but many do, and most of the people we work with that are financially independent do pay some tax on their Social Security income. It ultimately is means tested, meaning the more income you make, the more of it is taxed. But no matter how much you pay, no matter how much income you draw, 15%, of your Social Security benefit is tax-free, but up to 85% is subject to ordinary income taxation. And so Trump is saying he would eliminate that. When F.D. Roosevelt passed Social Security in 1935, he said, as long as I'm alive, you'll never be taxed on your Social Security income. Well, that didn't last, right? And in the 70s and 80s, we started creating taxes on Social Security income. So Trump's saying he'd remove that. The problem is that the money to make the system solvent must come from somewhere. And politicians have long been leery of touching Social Security when campaigning. It's common for politicians to pledge to protect Social Security and to not raise taxes that would fund it, but those things are incompatible. We know that the Social Security Trust Fund is going to run out in 9 or 10 years. But the reason politicians don't want to touch it is because their brain is hardwired to fight to protect individuals from loss. Nobody wants to have to face benefit cuts. Anybody who dares touch Social Security is going to have to answer to the electorate. So I think currently Social Security benefits are taxed by the federal government, and I don't think that's likely to change. I actually think in the coming years, with our federal deficits, we're likely to see an additional tier added that if you make over certain amounts, 100% of your income is subject to taxation. But what does that mean for the future of Social Security? It's a very important topic. I'm not a gloom and doom person. We do know that when the trust fund runs out on its current projections in about 9 or 10 years, the incoming dollars to pay for Social Security benefits will come 20% short of meeting the need, of meeting the requirement. In other words, in order for it to be funded, to put it in simple terms, everybody receiving Social Security would have to receive about a 20% reduction in their benefit. So that's scary on the surface. I don't think it's going to be a terribly difficult problem to solve. The problem is the politics of it. Can people get elected with that type of a message? Raising Social Security age to 69 from 67 today, that alone would really help tremendously with Social Security. We've had discussions. We've seen discussions out of Washington on that. We've also seen discussions of raising the cap on payroll taxation for Social Security, which would drive more dollars, more revenue into the Social Security system. I think what's prudent is, the older you are, the less you have to worry about this. If you're over 60, I think the chances of you having a reduction in benefit is very slim. I do think, though, you could end up seeing a little bit more taxation of your benefit, in spite of what Donald Trump said this week. If you're under 50, I think you're likely to see some reduction in benefit. But even if you're in your 20s and 30s, I don't think Social Security is going away. I don't think it's not going to be there for you. I just think there have to be some fundamental changes to the system. And so, it probably will be a reduced benefit for younger folks from what it is today. If you raise the full retirement age from 67 to 69, that is effectively about a 16% reduction in the benefit. So it is a reduction because you have to work longer to get the same benefit. And then the other thing is, I think Social Security election, especially for those that are near retirement, becomes even more important. I like to say Social Security election is going to be the most important election you'll vote on in retirement. Many of you may want to debate me on that with the current election coming up and the environment we're seeing today. But it's so important how you elect your Social Security benefit. People are living longer and longer lives, and there are benefits to delaying that benefit. Now, the flip side is many Social Security recipients cannot afford to delay their benefit. They don't have enough savings to get them through the gap if they delay the benefit. Or they may have the savings, but then they get to age 70 and you don't have hardly any money. That's not effective either. So your Social Security election is more and more critical. Now, I have an income planning class through Pellissippi State Community College out at Hardin Valley, and it is Tuesday, August the 20th. So it's a week from Tuesday, and it's a one-night class for 2 hours, and it's specifically on income planning. So Social Security, big part of that. Now, we also talk about tax planning, taxes on income, reducing taxes in the long haul. We talk about how to structure your investments to specifically provide for income. In the earlier segment, I talked about the fact that more and more as you get younger, you talk to younger folks, they are more and more attracted to the idea of guaranteed income in retirement. Should you be looking at paying that cost or not? I think having the income plan in place to support your income and understanding those dynamics is just critically important. So it's Tuesday, August the 20th at 6:30 p.m. It's a 2-hour class. It's just one night, 2 hours, Pellissippi, Hardin Valley. You can find out more information, PellissippiRetirementIncome.com. Again, PellissippiRetirementIncome.com. You can download a syllabus and click to register. Now, when we come back, I'm going to talk about legal documents, and do you need a trust or is a will sufficient? Stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
This is More Living here on News Talk 98.7 WOKI. Check us out online, BroganFinancial.com. We got a lot of resources. You can click on radio and listen to all of our podcasts. You can also go to Spotify or Apple Podcast, type in More Living with Jim Brogan. And then, of course, as I mentioned, we've got our class coming up Tuesday, August the 20th through Pellissippi State Community College. You can find out more about that at PellissippiRetirementIncome.com. But for our full class schedule for the entire fall, you can go to BroganFinancial.com and click on classes. I have gotten the same legal question several times just in the last few weeks from people that have come into my office for advice. Jim, do I need a trust or is a will sufficient? That's the question. Now, to be clear, I'm not an attorney. I am certified in estate and trust services. So estate planning is a big part of what we do. We don't draft legal documents, and there are limits to how deeply with legal stuff we can go, and we can't write legal documents. However, it's a very important question. When people ask that in that context, do I need a trust or is a will sufficient? It's talking about how your assets typically get passed to your heirs. There are different ways, different reasons you would create a will, a trust that you would use before your death. Many of those are irrevocable things, but when people say, do I need a trust or is will sufficient, they're talking about a revocable living trust. So it's a trust you create now while you're alive, and you're in total control. There's no independent tax ID number. The income flows through to your own Social Security number. You can put money in, you can take money out. You're in full control at all times. But what it does is it makes things easier when it passes to your heirs. And so that's why people talk about this. That's why attorneys talk about it. Should you put your stuff in a living trust? Because then if it's in the trust, your heirs, if it's done properly, will not have to probate your estate. See, if it's governed by the will, it is going to go through your estate. If you have a beneficiary designation and names an individual, you do not go through probate. And if you have your money in a trust, it does not go through probate. So now you can name beneficiaries on a lot of different investments, bank accounts, retirement accounts. A lot of the stuff you own, you can name beneficiaries if your main goal is just to bypass probate. You cannot give real property. You cannot get real property to heirs without probate unless you put it in a living trust. So do you need a trust or is a will sufficient? Well, it kind of depends. I can't give individual advice, of course, on this show. The more general thing I would say is that the probate process in Tennessee is pretty friendly compared to most states. It's not difficult. Now, if I took a straw poll, and I've done this before, I've taken straw polls of people that have been executors before that have dealt with probating an estate, and some say it's not very hard, and some say, many say it's a pain in the neck. But in Tennessee, compared to other states, it's not too bad. And there's not a specific probate tax or assessment on the assets that are in probate. Many states have a tax or an assessment on monies that go through probate. And in those states, you typically don't want to go through probate for even just your real property. In Tennessee, it's not as cut and dry. So, how much real property do you own would be a big question. Do you have other legal planning initiatives that could end up affecting that? Do you own property in multiple states? Owning property in multiple states, you live here, you own a condominium in South Carolina. That is a classic reason to consider doing a living trust, because then you could put the South Carolina, you don't want your kids to have to file probate in two different states, because you have to file probate in the state where the property is. So that would be a classic example of why someone would consider a living trust. Also, someone with a large estate may want to consider a living trust. Without getting too detailed, it provides you with more flexibility to make end-of-life estate planning changes if the tax laws change. Again, without going too far down that road, that's the main thing I like about living trusts, is if you have a high net worth estate, if there are changes in the tax laws, and maybe you don't have a tax issue today, but you do 15 years from now, you have more flexibility with a trust-based plan than you do with a will-based plan to make changes to your estate plan as the laws change. But if you just have your regular home and you don't, and your real property doesn't have a real high value, and you've named beneficiaries on all your accounts, you may not need to pay the extra money for a living trust. So it's just something that needs to be carefully considered. At Brogan Financial, we help our clients kind of evaluate this, and then we refer you to an attorney. We know several attorneys in the area. We can also work with your attorney. But we like to be involved in that process and make sure, give you some ideas of where we are, refer you to the attorney, and then also coordinate your planning with your beneficiary designations and with how you title your assets, and make sure that all gets taken care of. Because oftentimes people initiate an estate plan, they execute it, but then they don't fund things properly and title things properly, and they don't name beneficiaries properly. So we can help you kind of figure all that out. Unfortunately, we're out of time. Thanks for tuning in this week. We've discussed your wealth because greater wealth provides more living so you can live the best years of your life your way. Many thanks to Wayne for engineering the show. Thanks to Jill for helping produce the show. Check us out online at broganfinancial.com. This is More Living here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.